Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Omega Healthcare stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Omega Healthcare is a triple net REIT that funds and operates skilled nursing and senior living facilities. Triple net is a lease agreement where the tenant pays all the expenses of the property, including real estate taxes, building insurance, and maintenance. This type of lease provides a secure, steady source of revenue as opposed to traditional leases. Cash flow is more dependable with OHI since the expenses are the operator's responsibility. Plus, OHI only allows quality tenants to lease space from them. Its portfolio consists of 949 healthcare facilities in 42 US states and in the UK. The state with the most facilities is Florida, which makes up 15% of its portfolio. And that makes a lot of sense since there's lots of retirees in Florida. Texas is the second largest state with 10% of its portfolio. Its specialty is skilled nursing facilities, or SNFs. That makes up 78% of its portfolio. Nursing homes are where people usually go when they require high levels of assistance with non-medical everyday living tasks. On the other hand, SNFs are where people go who need medical care. If somebody was recovering from a stroke, they would go to SNF. The staff in these facilities are very knowledgeable and can safely and effectively perform the necessary tasks. The workers are required to treat, manage, and observe a person's condition. SNFs are primarily funded by Medicare and Medicaid, which makes them a fairly safe investment. The company is headquartered in Hunt Valley, Maryland, and was founded in 1992. It can be found on the New York Stock Exchange, London Stock Exchange, and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 6.6 billion market cap. They're trading at $28 a share, and they have 239 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see they're doing better and better each year. COVID didn't hold them back at all. Their free cash flow is the highest ever in the trailing 12 months at $658 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that peaked in the trailing 12 months at $457 million. Revenue is a sales for the company, and that broke through $1 billion for the first time in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. They have really low cost of revenue since they're a REIT. Below that is their gross profit, and below that is their operating expenses, which are all the expenses not directly related to generating the revenue. And that's where most of their expenses are. And below that is their operating income, which was over $600 million in trailing 12 months, which was a lot higher than prior years. Below that is the interest they pay in their debt. REITs tend to have a lot of debt because they have to distribute at least 90% of their income to their investors in the form of dividends. So they don't have much money left over to grow the business. So they need to take on debt or add stock. So the interest payments on their debt are going up each year, with $235 million in the trailing 12 months. And the bottom line of the income statement is their net income, which is positive every year. This is the company's income statement from the latest quarterly report. They show us the first 9 months of 2020 versus the first 9 months of 2021. Also the third quarter of 2020 versus the third quarter of 2021. Their rental income went up a lot from $83 million to $247 million. Some of the tenants don't rent from them, they buy from them. So this company supplies a mortgage. They receive $23 million of mortgage interest and $11 million of other investment income. Omega also provides loans to their tenants to help them fund working capital and also capital expenditures. The interest they receive on those loans goes into other investment income. A couple of the loans have really hefty interest rates, over 13% on one loan, 12% on another loan. The reason their rental income was so low in the third quarter of 2020 versus the third quarter of 2021 was due to write-offs. You'll see on the statement of cash flows later that they brought in a similar amount of cash flow in both quarters. This is mentioned in their 10-Q. There were significant write-offs with these two operators. They have lots of depreciation, $81 million in the third quarter of 2020 versus $86 million. They had $15 million in G&A. Payroll expenses are part of G&A. Also rent and insurance for its corporate office. $3 million in real estate taxes. They had $28 million of impairments in the third quarter of 2020 and $5 million in the third quarter of 2021. An impairment is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. Provision for credit losses is $25 million. I'll talk about this later on the cash flow from operations section. They have a good amount of debt on their balance sheet. They paid $59 million of interest on their debt. And they had a $56 million gain from the sale of real estate. So they had $143 million of net income compared to negative $94 million. In the first 9 months of 2020, it's $100 million compared to $394 million. But I'll show you in a cash flow from operations section how they brought in similar amount of cash flow in both time frames. You can see it was a big difference in net income, but I'll show you later cash flow was very similar. They had a gain of $161 million in the first 9 months of 2021 from the sale of assets. This is the sale of some of their properties. This is an accounting gain, it's not a cash gain. We have to minus this out on the cash flow from operations section because it belongs on the cash flow from investing section. I'll give you a basic example of how this works. Say you bought a rental property for $100,000. When you buy a rental property, you have to depreciate it. You don't have to depreciate it if you live in a property. But if it's an investment, you have to depreciate it. So say you depreciated $10,000 in the first year, $10,000 in the second year. So the book value of the property is $80,000. That's the value on your balance sheet. And say you sell the property for $110,000. That means you have to report a $30,000 gain on your income statement. That's an accounting gain. When you sold the property for $110,000, that's a cash inflow of $110,000. A couple years ago when you bought it, it was a cash outflow of $100,000. So we would have to report a cash inflow of $110,000 on a cash flow from investing section. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they do generate a lot of cash flow. They invest around $100 million a year in CapEx. When they buy a property, the cost of that property goes into CapEx the year they bought it. Operating cash flow minus CapEx gives you your free cash flow. And most of their free cash flow goes towards paying a dividend. A REIT is supposed to distribute at least 90% of their taxable income back to their investors in the form of dividends. That means there's only 10% left over to grow the business. That's why REITs tend to add a lot of stock and debt. You can see each year they add capital stock. When a company issues common stock, it dilutes the current shareholders and makes your shares less valuable. In the past few years, they haven't really added much debt. They seem to pay off a similar amount of debt as they issue. This is the company's cash flow from operations section from their latest 10Q. The first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the $400 million of net income. We add back depreciation, that was $256 million. We add back the impairments of $42 million. They have to post provisions for rental income and provisions for credit losses, $22 million and $28 million. These are non-cash items. Provisions are funds a company sets aside for future losses. If you wanted to buy a $2,000 computer and you knew it might take a little time to save up for that, you might put $200 in a drawer every month for the next 10 months. The $200 is a provision. You didn't actually spend any money. When you post a provision, you have to pass that through as an expense onto your income statement. So it brings down your net income, but you add it back on a statement of cash flows because the cash never left. When you actually pay for the computer, then it's a cash outflow. $40 million of amortization of deferred financing costs. I explained this in more detail in a prior video. $17 million of stock-based compensation. And here's the $160 million gain. On the income statement, they posted a gain of $160 million from the sale of real estate. We minus that out here because we're going to report the entire cash gain on the investing section. And this $160 million is their accounting gain, not their actual cash gain. Just like in the example earlier, the $30,000 is your accounting gain. You have to pay taxes on the $30,000 because you depreciated $10,000 a year for 2 years, plus you gain $10,000 on the sale versus the original purchase price. And then here's their changes in working capital. The straight line rent receivables. This is related to the 2 operators that aren't paying. So you can see their net profit was 4 times larger in 2021 versus 2020, but they generated a similar amount of cash flow in both years. That's why I like to look at cash flow as opposed to net income, especially for REITs. The income statement is not appropriate for REITs. Because of all the depreciation, as well as the sale and purchase of real estate, it can really skew the numbers on the income statement. We'll look at funds from operations later, which is a better indicator than net income. Let's look at their cash flow from investing and cash flow from financing section. This shows us the first 9 months of 2020 versus the first 9 months of 2021. It looks like they bought a bunch of new properties and spent $616 million in the first 9 months of 2021. And they received $311 million from the sale of real estate. Remember earlier in the example, if you bought a $100,000 property, sold it for $110,000, that $110,000 would show up as a gain in the investing section. Since they received $311 million from the sale of real estate, that all goes into the investing section. They had a $91 million outflow in construction in progress. It looks like they issued more mortgage loans. That was $84 million. They collected $44 million on the principal of those mortgage loans. So the principal goes into the investing section. The interest goes into the operations section. They spent $29 million on capital improvements on some of their properties. They had a cash outflow of $452 million in their investing section. In their financing section, they issued $2.2 billion of debt. They paid down $2.1 billion of debt. They issued $270 million of common stock. They paid $477 million of dividends. So in their financing section, they had a cash outflow of $175 million. In the prior period last year, they had a cash outflow of $447 million. The big difference was they didn't issue much common stock in the first 9 months of 2020. This is the equity section of their balance sheet. They have $4 billion of equity. They raised $6.4 billion from selling their business. They profited $3 billion from running their business, and they paid out $5.4 billion of dividend payments. Let's look at the capital structure. $4 billion of equity, $5.3 billion of debt. They have 43% equity, 57% debt. I gave them the highest whack on Finbox, 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated their future free cash flows up through 2024. We also estimated the terminal value, which is all cash flows past 2024. That's $11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.3 billion. We divide that by 239 million shares. And we get a calculated stock price of $39. They're trading at $28, so they're trading at a 29% discount. It's a buy according to the model. The average analyst projects their revenue to grow 4.7%. I grew their revenue annually 4.7% up through 2024. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 55%. So I multiplied their future revenue estimates by 55%. That's how I got their future free cash flows. Simply Wall Street is way higher than me. They're at $87 a share. They're saying it's 68% undervalued. 6 analysts priced this stock and the average price target is $35. This section talks about their tenants that have defaulted. One of them is Gulf Coast. That was in the second quarter. 1 operator in the first quarter and 2 in the third quarter. These 3 tenants combined make up 0.3% of their revenue from the first 9 months of 2021. So it's a pretty small part of their portfolio. During the March 2020 crash, this stock really struggled, as most stocks did, especially REITs and especially real estate stocks. Real estate stocks declined a lot more than the average industry. But it seems like this company is doing well. Their revenue and cash flow is a lot higher than pre-COVID. Their stock did climb up for about a year straight, close to $40. But in the past 6 months, it's dropped a lot, about 50%. Their beta is close to 1, so the stock moves with the market. It's gone down 27% in the past 52 weeks, while the S&P is up 27%. The 52-week low was 27, the high is 39. And the stock is trading below its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock. Of the 239 million shares outstanding, 238 million are on float, 69% are held by institutions, and over 9% of the shares on float are shorted. And they pay a really generous dividend, nearly 10%. We shouldn't look at the dividend payment over net income, because net income is not a good indicator for REITs. We should look at dividend payment over free cash flow, and that's 97%. If you looked at this number over a long period of time, it should equal pretty close to 90%. Their industry pays a 2.8% dividend. They're much higher than their industry. They don't need many employees. They only have 68 people working there. Company insiders have been buying and selling, although the sell orders are much bigger than the buy orders. There's a sell order of 50,000, 25,000, 20,000, 30,000, 175,000, where the buy orders are really small, 500 to 1,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $31,000 today. That's a 12% annual return. 68% of the shares are held by institutions, 32% by the general public. The biggest shareholder is Vanguard at 15%. They own 35 million shares. The valuation of that is $960 million. Then BlackRock, State Street, BNY, and Geode. Let's look at their financial ratios. They have a really good PE of 14.4. Their price to sales is between the market median and average at 6.1. And they have a good price to book at 1.6. Their return on invested capital is only 6%. They can cover their interest payments almost 3 times. They have a really good ROE at 11%, and they have a high current ratio and quick ratio. So they do seem to be well capitalized. They generated $658 million of free cash flow in the trailing 12 months. They have over $1 billion of working capital, and they paid out $640 million of dividend payments. So they have a little over $1 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 7 companies in the same industry as Omega. And if Omega has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So when you look at a REIT, you should look at the price of the stock over funds from operations per share. Funds from operations is net income plus depreciation and amortization minus the gain on the sale of real estate. The lower the better for this number, and they're at 9.4, which is better than the average in the industry. They're also better than average in price to earnings, price to sales, a little worse than average in price to book. They have a high current ratio. Their ROE is a little higher than average. They're pretty much average in debt. They are smaller than the average company. They're 6.6 billion. The average is 9 billion. And they do pay the highest dividend. So to summarize, I have them trading at a 29% discount. If you're looking at 10, 20, 30x on investment, this is not the stock for you. If you're looking for stable cash flows, this is a good stock, and you could possibly 2 or 3x on this stock over the next few years. Although it's much more likely for the stock to grow 10 or 15% max. And the reason REITs don't grow as much as a regular stock is because when a company pays out a dividend, the stock price goes down a similar amount as a dividend payment. Their dividend is close to 10%. If they didn't pay that dividend, their stock would go up 10%. And of course, it could go up even more due to regular stock price appreciation. It seems like a pretty stable investment, and I think the dividend is pretty safe. They have a really solid portfolio, so it seems like a really good long-term hold. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.